Alright, picture this. You wake up one morning, grab your coffee, check your phone, and bam, your bank app isn't working. You head to the ATM, no cash. Wire transfers, delayed. You call customer service, and they give you a scripted excuse that makes 0 sense. Sounds like a nightmare, right? Well, it might be closer to reality than you think, because listen. 5 major banks are on the verge of collapse. Yep, you heard me right. And this isn't just some random conspiracy theory. This is based on hard data, global financial trends, and warnings straight from insiders who've been watching the cracks widen for years. Layoffs are piling up, liquidity is drying out, commercial real estate is imploding, and guess what? The banks are quietly hoarding bonds instead of lending money. That's not just strategy, that's survival mode. They see the storm coming, and instead of sounding the alarm, they're bracing themselves, while most people have no clue what's about to hit them. Here's the kicker. When things start unraveling, it won't be a slow, predictable breakdown. It'll be sheer chaos, a full-on liquidity panic, the kind where the Fed won't swoop in to save the day. Deposit insurance won't be enough to cover your losses, and the billionaires? They'll already have their money safely moved before you even realize what's happening. That's exactly why you need to be prepared. You need to know which banks are teetering on the edge so you can act before it's too late. Stay with me, because I'm not just breaking down the 5 banks most likely to collapse in 2025. I'm also going to show you where the smart money is heading right now and what steps you can take to protect yourself before the dominoes start falling. Don't miss it. This could be the most important financial warning you hear this year. Number 5, Wells Fargo. Alright, kicking off the list we have Wells Fargo. This bank was once seen as the golden child of American banking, a too-stable-to-fail institution. But fast forward to now and things look a lot shakier. Its reputation has taken hit after hit thanks to a cascade of scandals and constant blunders over the years. Remember the fake accounts scandal? Yeah, that's still haunting them. Millions of phony accounts were opened under customer names, and even though Wells Fargo tried to clean up the mess, trust doesn't rebuild overnight. If anything, these scandals have left a lingering question in everyone's minds. Can this bank actually stay afloat if things really go south? Here's the deal. Wells Fargo's problems don't end with bad press. They're grappling with consumer distrust, regulatory fines that have drained billions from their funds, and a shaky loan portfolio that's under extra pressure as the economy teeters on the edge of a serious slowdown. Banks like Wells Fargo thrive in stable times when there are strong borrowers and booming businesses. But when the economy stalls or contracts, things get messy. If the US falls deeper into financial trouble, like a gnarly recession, Wells Fargo's already compromised credibility might transform into a full-blown crisis. Now, about their tightened lending standards. That's a red flag you can't ignore. Recently, Wells Fargo and other big banks have started making it tougher for people and businesses to borrow money, from home mortgages to small business loans. This might seem like a logical move to protect themselves, but it also means fewer people get access to credit. This tightening can quickly spiral out of control. Less borrowing means less spending. Less spending leads to business closures, layoffs, and, in a debt-driven economy like ours, that starts a domino effect. Wells Fargo gets squeezed from both sides, dealing with potential defaults from past loans while pulling back so hard on new lending that they risk drying up their own growth pipeline. But hold on, there's more. Deposits are quietly draining out of Wells Fargo as customers leave in droves for smaller, supposedly more trustworthy banks or even its larger competitors. A quarterly report even confirmed that customer deposits are steadily declining. Now, imagine what happens in a panicked situation. If something even slightly shocking sends people to pull out their money en masse, Wells Fargo would suddenly be scrambling for liquidity. Millions rushing to ATMs and withdrawals? That's not good news. And don't forget their huge exposure to commercial real estate. Office spaces are sitting empty all over the country post-pandemic. If landlords owning those buildings can't keep up with interest payments due to high rates, defaults will pour in. And guess whose books those bad loans are on? Yep, Wells Fargo's. If rates stay high or tenants don't come back, count on Wells Fargo's balance sheet taking a hard hit. Wells Fargo's balancing act between risk management and its desperate need to grow only gets more precarious as 2025 looms closer. If the economy takes a downturn, Wells Fargo may find itself standing on incredibly shaky ground. Will they collapse completely? Who knows? But right now, all the warning signs are there. Number 4, Deutsche Bank. Coming in next at number 4, we've got Deutsche Bank. This one's been a ticking time bomb for quite a while. Rumors, headlines, and market whispers about its fragility have been circling for years. And guess what? 2025 could finally throw this bank into full-blown chaos. If systemic issues and economic challenges continue to pile up, Deutsche Bank might find itself crumbling under the weight of its problems. Here's the thing about Deutsche Bank. They've been through what feels like a never-ending parade of restructuring efforts. From cost-cutting plans to mass layoffs, they've done it all. But the underlying issues haven't gone away. The elephant in the room? Their monstrous derivatives portfolio. We're talking about trillions of dollars in highly complex financial instruments like credit default swaps and interest rate swaps. And while Deutsche Bank might insist this is all totally manageable, the reality is their portfolio makes them a prime candidate for disaster if Europe finds itself in financial trouble. And speaking of Europe, things are anything but rosy. Inflation is sky high, economies are slowing down, and central banks are stuck playing a painful balancing game. They either fight inflation by hiking rates, which risks pushing fragile economies into recessions, or they ease up and inflation runs wild. Neither scenario is great news for Deutsche Bank. Higher rates lead to more loan defaults from both individual and corporate borrowers, which tighten its already stressed reserves. But if central banks backpedal to save the economy, inflation eats away at real lending growth. It's a lose-lose situation. Deutsche Bank is also deeply tied to energy and industry, heavy economies like Germany. That's great when things are stable. When things aren't, not so much. Predictions of energy shortages in Europe, ongoing geopolitical troubles, and trade tariffs from America could directly impact Deutsche Bank's clients, making it harder for the bank itself to recover loans. Imagine German industrial giants faltering because energy prices spike, or real estate developers going bankrupt thanks to rising costs. Deutsche Bank would feel every single blow. And then there's the trust issue. Investors don't have a lot of faith in Deutsche Bank anymore. Not when you've got so much leftover baggage from past scandals and legal troubles. Do you know they're still paying fines linked to misconduct from years ago? That erodes confidence in their leadership and financial health. If things spiral out of control, Deutsche might struggle to attract the emergency capital it would need to bail itself out. If liquidity dries up, which by the way happened to a lesser degree in past crises for this bank, they might have to sell off assets dirt cheap. That kind of fire sale could topple not only Deutsche Bank, but also some of Europe's financial heavyweight friends, thanks to how interconnected everything is. Analysts are genuinely worried that if Deutsche Bank tumbles, it'll be game over for multiple institutions across the continent. It's not just a German problem, it's global. Bottom line, Deutsche Bank has been skating on thin ice for decades, and the cracks seem to be widening. By 2025, this could be the bank that sets off a financial chain reaction no one is ready for. You might want to reconsider keeping your money tied into places that rely so heavily on a giant with so many weak links. Number 3. Barclays. Alright, coming in at number 3 is Barclays. This bank has a history dating back over 300 years and carries the reputation of being one of the oldest and most established banks in the world. But as we head toward 2025, all that history and size might not be enough to save it from what looks like a brewing catastrophe. If you think Barclays is bulletproof, it's time to take a closer look under the hood. The first major concern: rising defaults. Over the past couple of years, Barclays has seen its non-performing loans creeping up. Not a great look. This means more people and businesses are struggling to repay what they owe, and for a bank like Barclays, which has huge exposure to shaky European markets, that's a massive red flag. Combine this with a struggling European economy due to stagnant growth, stubborn inflation, and unpredictable monetary policies, and you begin to see how Barclays' foundation might not be as solid as they'd like us to believe. Bad loans don't just stay bad. They snowball, eating into profits and sending risk levels through the roof. Now, let's talk about commercial real estate. Barclays has pumped a huge amount of money into property loans across the UK and parts of Europe. That worked just fine when offices were full and tenants were happy, but the world has changed. Remote work is here to stay, occupancy rates are down, and landlords are facing the squeeze. If property owners can't keep up their payments, those bad loans could ricochet straight back to Barclays' balance sheet. Oh, and don't forget interest rates. With rates climbing higher and central banks signaling they're not going down anytime soon, the value of these loans could tank even further. If Barclays is left holding billions in devalued real estate, they're looking at some serious financial pain. Here's something else to chew on. You've probably heard all the talk about derivatives, right? Complex financial instruments like currency hedges and interest rate swaps. Well, Barclays is knee-deep in these, and that's risky business. Why? Because when markets get rocky, derivatives are often the first to feel the heat. The bank could be forced into a brutal fire sale just to meet margin calls if things start to go sideways. For a bank that looks big and strong on the surface, this is exactly the kind of thing that can lead to its downfall. And it doesn't stop there. Barclays' retail banking sector is also taking a hit. Rising living costs across Europe are crushing consumer spending, leading to fewer mortgages, car loans, and even an uptick in defaults on credit cards. Less income, more defaults. That's a deadly combo for a bank that depends on retail lending for a massive chunk of its business. Sure, Barclays has tried cutting costs to make up for lost revenue, but you can only slice so much before the real vulnerabilities start to show. To top it all off, Barclays has been grappling with a series of compliance failures and PR disasters. Trust is everything in banking, and once customers lose confidence, panic spreads fast. If enough depositors get spooked and start pulling their money out, Barclays could find itself in an all-out scramble for liquidity, triggering a ripple effect across the global financial system. By 2025, Barclays might not just be in trouble. It could be staring at a complete financial meltdown. If you've got your money tied up in anything connected to this banking giant, it might be time to start asking tough questions. Number 2. HSBC. Next up, we've got HSBC at number 2. This bank is a global powerhouse, but too big to fail might just be a myth when it comes to 2025. With operations spanning Asia, Europe, and the Americas, HSBC's international reach has always been its strength. But here's the kicker. In a global economic downturn, that same sprawl could be its Achilles heel. And trust me, HSBC has some serious problems bubbling under the surface. One of the bank's biggest vulnerabilities lies in its ties to emerging markets, especially in Asia. Emerging markets might have had a solid growth story in the past, but the tide is turning. Corporate debt in these regions has skyrocketed, inflation is a constant headache, and local governments are struggling to keep things under control. HSBC's deep involvement in these fragile economies means it's exposed to enormous risks. Add to that its complex relationship with China, and the picture gets even messier. Beijing's economic policies flip-flop between injecting liquidity and tightening markets, leaving big banks like HSBC stuck navigating a maze of unpredictability. And don't even get me started on the capital flight from China, which spells bad news for HSBC's operations in Hong Kong and beyond. But wait, it's not just China. HSBC thrives on global trade, but geopolitical tensions, trade barriers, and tariffs are choking off much of the seamless flow it depends on. Those transactional and fee-based revenue streams that once padded its profits are in jeopardy, and when there are fewer trade deals and less movement of goods, HSBC's vast cross-border operations can quickly turn from an asset into a liability. It's the classic big ship hard-to-steer problem in action. Then there's the matter of overhead. HSBC employs tens of thousands of people globally, and that massive workforce creates an enormous fixed cost that's hard to adjust when economic conditions shift. While they've tried moving to digital platforms and laying off workers, the reality is you can't streamline your way out of a global slowdown. Internal memos leaked recently hinted that HSBC leadership is already bracing for tough times ahead, quietly preparing to shore up their cash reserve. That's great unless the perfect storm hits and those reserves just aren't enough. HSBC has also been dramatically increasing its holdings of government bonds instead of lending, and here's why that's a red flag. It's one of the telltale signs of a bank hedging for a crisis. Hoarding treasuries might keep their books looking okay for now, but this lack of lending hurts businesses and consumers, creating a self-fulfilling cycle of slowed growth and rising risks. But the real question at the end of the day is whether HSBC's global footprint will save it or take it down. On one hand, diversity in revenue streams could act as a buffer. On the other hand, being stretched so thin could mean every little crisis, from a property collapse in the UK to surging defaults in Asia to shrinking consumer credit in the US, will reverberate across its operations like an echo chamber. If HSBC goes under, it won't just be a regional problem. It'll be a worldwide financial earthquake. That's the level of interconnectedness we're talking about here. Keep an eye on this one, because when the dominoes fall, HSBC could very well be at the center of the storm. Number 1, JP Morgan Chase. Alright, sitting at the top of this list, and probably shocking more than a few of you, is JP Morgan Chase. Yeah, the biggest bank in the United States, the one with trillions of dollars in assets, a global footprint that spans markets across every major continent, and a reputation as a fortress bank. But here's the thing about fortresses. Even the biggest ones can fall. And if some analysts are right, JP Morgan could be staring at a massive collapse by 2025. Now, before you roll your eyes, hear me out. Just because a bank is huge doesn't mean it's indestructible. Sometimes being too big is actually the problem. JP Morgan's sheer size might make its collapse far more catastrophic, both for the US and the global financial system. That's why this bank deserves your attention. Beneath the surface, a storm might be brewing that not even their praised fortress balance sheet can withstand. One key risk is their absolutely massive derivatives book. We're talking about trillions of dollars tied up in contracts that most people, even some bankers, don't completely understand. The problem with these derivatives is that they're extremely sensitive to market shifts. And with the global economy becoming more unstable by the day, those derivatives could quickly spiral into losses so large they're impossible to contain. Remember, these aren't just small bets, they're like playing poker with the fate of the banking system. Now, JP Morgan has gained a reputation in the past as the bank that cleans up during crises. They've swooped in and snapped up troubled institutions, building their empire every time something went south for the financial sector. But what happens if they become the epicenter of the next crisis? That's a very real concern. Much of JP Morgan's aggressive expansion in corporate lending, mergers, and acquisitions happened during a time of cheap money and confident markets. Deals were struck assuming interest rates would stay low and economic growth would hum along smoothly. Fast forward to today, and that world doesn't exist anymore. Interest rates are hiking up, corporate debt levels are ballooning, and defaults are tiptoeing to the edge of disaster. If U.S. companies start defaulting on their debts in larger numbers, and trust me, they're dangerously close, JP Morgan is going to have a serious problem on its hands. Billions in losses could hit their loan books and trading accounts almost overnight. Add to that the waves of market panic that tend to come with crises. Investors could dump bonds, creating a sudden sell-off that throws JP Morgan even deeper into trouble. And here's where it gets really dicey. If things get bad enough to scare depositors, we could see a full-scale run on their deposits. Even fortress banks fall when confidence collapses. But wait, there's more. JP Morgan's investment banking arm isn't immune either. This segment thrives when deal-making and corporate activity are booming. If economic uncertainty crushes mergers and acquisitions, JP Morgan could find yet another income stream drying up at the worst possible time. That would leave the bank far too dependent on net interest income, which would be a problem if defaults continue to climb higher. Here's another potential issue no one talks about enough: regulations. If lawmakers sense a meltdown is brewing in the financial sector, they tend to act fast. Stricter capital requirements or emergency stress tests could force JP Morgan to liquidate some of their riskiest assets. And do you know what happens when a big player like JP Morgan starts selling off assets? It sends prices crashing across the market, creating a domino effect that pulls other banks down with them. Sound familiar? That's basically what happened in 2008. At the end of the day, JP Morgan Chase might look like an impenetrable juggernaut, but history shows that the market has a way of humbling even the giants. If they misstep in this rapidly shifting economic landscape, the fallout wouldn't just be financial headlines. It could be an all-out market meltdown. Keep a close eye on this one, because when titans fall, they don't fall quietly. In conclusion, the financial risks facing these major banks, whether due to economic instability, unsustainable business practices, or overexposure to volatile markets, are real and significant. From HSBC's global interconnectedness to JP Morgan's over-leveraged derivatives, the warning signs are hard to ignore. The collapse of any one of these institutions wouldn't just impact their immediate stakeholders, it could send shockwaves across the global economy. For individuals, businesses, and investors, now is the time to stay informed, reevaluate financial strategies, and take proactive steps to safeguard assets. When it comes to your money, it's better to act early than to react too late.